Hello everyone, my name is Glenn Pierce. Today we're going to be discussing the Bush tax cuts and how they affected the deficit. To do so, we're going to be talking about Laffer curves. And what a Laffer curve is it's an economic model that graphs how tax rates affect government revenue. So, to begin, Laffer curve is defined by 2 points. Over here on this axis, you've got your tax rate, and up here you've got your government revenue. At the 0% tax rate, you get zero revenue. 0% times anything you're taxing is zero revenue. Over here at your 100% tax rate, you also get zero revenue, because everybody moves out of your country rather than pay 100% tax. So it makes sense that as you increase your tax rate from 0% on up a little bit, you get more government revenue. Good sense? And over here at your 100% tax rate, as you decrease your rate, you get more revenue. Very, very sensible. Now there's a couple of different problems with this model. Number one, in the real world, it looks more like this. We don't have a very clear idea of where we are on the curve. When we do comparative economics between different countries, they fall in different places on the expected curves. And part of this is because countries have different things that affect their tax rates rather than just have different things that affect their revenue rather than just the tax rate. Furthermore, we in the U.S. don't have a flat tax. Our tax rates can't be measured on a linear scale like this. We've got marginal tax rates. We've got taxes on different activities. You've got wages taxed at one rate, capital gains at another, estate taxes at a different rate. So this isn't a good model in the real world. Nonetheless, President Bush said, I think we're over here on this curve. He said, I'm going to reduce the rate, I'm going to increase revenue. People are going to be more incentivized to work, they're going to work longer hours, they're going to work more, they're going to work harder. Okay? So we've got a couple of different scenarios. You're making $100 a day here, you're at a 25% tax bracket, so you make $25 to the government and $75 goes in your pocket. Mr. Bush said, I think what's going to happen is you're going to work more, you're going to work harder, you're going to work for $130 a day now, because you're going to work 50 hours instead of 40. And you're at a 20% bracket. I've cut your rate. That's why you're working harder. So now the government actually gets more revenue. They get $26 instead of that measly 25, and you bring home 104. Not bad. A couple of questions. Is the government using this money wisely? Is it spending it on good infrastructure, good education for the citizens? Is it protecting our national borders? If not, then we're just wasting this money. If it's being spent on corruption and wasteful spending, increasing government revenue, not a great thing for the U.S. economy. Okay, but the increase in personal revenue, that is a good thing for the economy. But there's a couple of things. Number one, we don't live in a world where everybody gets to just spend more hours working and making more money as a result. You might be a salaried employee. And as a salaried employee, you say to yourself, well, that's wonderful. I get a little discount on my taxes. Government gets less revenue in this case. And I get more revenue. Now, if you're really wealthy, or if your revenue is fixed by other factors besides just how much you work, it's capital gains on inheritance, then this doesn't affect you too much in terms of whether or not you're going to make more money. It's just going to affect how much of it you get to take home. And are you going to take that money home, or are you going to spend it abroad? Are you going to spend it on things that aren't helping the U.S. economy directly? This is a good question. We don't know the answer to that necessarily. Now lastly, the Laffer curve is a classical economics tool. It assumes that everybody is driven by money, that they will maximize their return on investment, they will maximize their earnings potential. But what if instead we live in a world where behavioral economics has an impact? And you say to yourself, you know what? The extra money is nice, but I'd rather spend the time with my kids. So I'm gonna reduce my hours, make a little bit less. The government gets a little bit less, but I end up with the same. Not a bad deal for me. That's what it boils down to, folks. We don't know directly where we are on this curve. We don't know how people are going to respond when we cut the taxes. There's so many factors out there, it's almost impossible. We don't know if they're going to spend the money the way that they should, but what we can control is how the government spends our tax dollars and whether or not that is of a benefit to us. So that's what we need to be focused on, in my opinion. Not what the rate is. The rate's a fine rate. We've got good rates. In fact, we've got some of the lowest rates out there now, thanks to President Obama. But is the government using that money effectively and efficiently? These are the questions we need to be asking ourselves. Thank you very much.